Hi, this is Greg. Welcome to the channel. And on this channel we talk about business and investment. And we've been talking quite a bit recently about the stock market and how you can make money in the stock market with various ideas that I have. But in this video we're going to be talking about this new round of stimulus that's coming from Washington. It's the third round now, and how it might potentially completely tank the stock market. So that's what we're going to be talking about in this video, and if you're interested, stick around because it's coming your way. Okay, so what's been going down in Washington is politically understandable, but ironically, as is frequently the case with government policies, it could produce an unintended effect. Even though they try to be well-meaning, they're just not too bright when it comes to the market and the economy. And if you've been following the news recently, you would know that Congress is about to ram through budget reconciliation, which requires just a simple majority, a new and third stimulus package right on the heels of the $1 trillion that was just passed by the Trump administration before he left. Another $1.9 trillion of government spending, money going to frequently, unfortunately, people that don't even need it, at a time when the vaccination is coming in and it looks like the economy is beginning to repair itself on its own. Now, the important thing to realize when you're looking at this situation is that politicians basically do what is most expedient for them, or what they perceive to be most expedient to them with respect to politics. Okay, they have been hearing from the states, which have huge budget problems because they shut down their economies, and they're talking to a lot of people who, you know, rightfully so, have lost their jobs, which is terrible. And we've talked about which industries, travel, leisure, and other industries, that have been severely hurt by the pandemic. While all of these objectives are good objectives, they're really going overboard with this third stimulus package before the money from the last stimulus package has even been spent. In fact, only a small fraction of that money has been spent, and here they are all jumping on the bandwagon without bipartisan support, which Joe Biden promised. So much for Joe Biden's promises. And now he's just going to ram it through with a simple majority and only Democrats, without any discussion, without any committee hearings. And I believe this is very, very short-sighted and will produce unintended consequences that we're going to talk about in a second. Now, the thing that's so amazing about this is trillions of dollars that we're talking about, okay? The number trillions was never even used in politics until this pandemic thing came in. And now everyone's talking trillions. You know, they talk a trillion here, trillion there. You know, it's like these people don't even understand what a trillion is. Now, unfortunately, this is all borrowed money. It's all money that's going to have to be paid back by future generations. And it could take years and years, many, many years, to pay this back. So you would think you would make sure that it was even necessary before you embarked on something like this. But we're not going to get political here. What we're going to do is we're going to analyze this, and we're going to come to a conclusion as to what's happening right now and to what the markets may be anticipating, particularly the bond market. So let's start by taking a look at what the bond market has done over the last 6 to 9 months. Okay, so here we are, and this chart shows the 10-year Treasury rate. And I'm focusing on the long end because the Fed is pretty much controlling completely what's going on in the short end. So it has, you have to go farther out on the curve to take a look at anything that's going on based on actual people buying and selling securities. So if you take a look at this, and we've done a similar analysis on this on a previous video called "What is the Bond Market Telling Us?", which I would encourage you to look at, and I'll put it in the description below and at the end of the video. But if you take a look at this, and it goes back to March, goes back to March. There's March 9th. That was the initial dip in rates that was a flight to safety when the pandemic started. But let's take a look at particularly from August 5th, or looks like the low was August 4th, 0.52%. Okay, now that wasn't that long ago. And look at where it is today. It's at 1.19%. And if we take a look even more recently, January 4th, 0.93% to 1.19. That is an increase of 26 basis points, or 0.26%. This is an enormous rise in a relatively short period of time. So obviously the bond market is telling us something, and we're trying to figure out here, what is the bond market telling us? Now typically what this would indicate is it would indicate that the bond market is discounting, so to speak, higher inflation. Okay, and why is it discounting higher inflation? It's discounting higher inflation because the government is flushing trillions and trillions of dollars into the economy with borrowed money, and I think that the market is discounting that the economy could overheat. So here's how I analyze it, okay? And this is not without precedent, okay? The economy, with the vaccine coming in and with the jobs market seemingly starting to improve, which you can see in some of the economic data. The economy, once the pandemic lifts, etc., will repair itself by itself on its own. And remember, there's $1 trillion sitting there. Most of it has not been used yet from the last stimulus package. So I believe that this stimulus package is not only not needed, but even if it were needed, it's far too large. It's far too much money. Now, Joe Biden said he would work with Republicans. That turns out to be complete BS. He's not going to work with Republicans. He's going to put this through, ram it through, so to speak, just like Obamacare was rammed through, by the use of budget reconciliation, which requires only a majority and not the 2/3 majority in the Senate. Now, when you flush that much money through the system and you give that much money to people that basically don't need it, it's going to stimulate economic activity. That's Economics 101. And it's going to cause inflation to rise as all this money is flushed through the system all at once. When inflation rises, the bond market gets spooked, as it already has been, judging by that 26 basis point rise that we were talking about. And inevitably, it'll catch the attention of the Fed. And let me tell you this, and this is not without precedent, if the Fed gets even the slightest inkling that inflation is moving above the 2% target, it will start to indicate that it might consider raising interest rates. It doesn't even have to signal that it is raising interest rates. In this environment, with the stock market so overvalued, all they have to do is signal that they're thinking about raising rates. Thinking about raising rates, and the market will have what's called a taper tantrum. Now, a taper tantrum is not without precedent. As I said, in the summer of 2011, there was an inkling that the Fed was considering raising interest rates, and there was what was called at that time a taper tantrum, i.e. that the Fed is considering tapering its purchase of securities in the market called QE, which, just to review, that's when the Fed prints money and goes out into the market and buys bonds. And the Fed is currently printing and buying $80 billion of bonds per month, which is a huge amount. And the idea that they would begin to taper, I think, will cause these excessive valuations in the stock market to crumble almost overnight. So I'm not the only one who thinks that this situation is developing. Stanley Druckenmiller, who I've had excerpts of various interviews on this channel in the past. Stanley Druckenmiller, for those of you who don't know, he's one of the most successful and most world-renowned investors on the planet. He started the Quantum Fund with George Soros many years ago, and he's had his own investment vehicle, Duquesne Capital, for many years, and over some ridiculous 30-year period, he's never had a down year. And the IRRs that he's achieved have been phenomenal. So he's probably one of the smartest guys on the planet when it comes to the markets. So I wanted you to take a look at a short clip, an excerpt from a clip, an interview on the subject that we're talking about, and then I'll come back and make some comments.
We're clearly living through and investing through a truly historic period in many regards. So as you look at everything that's taking place, what's your current framework for the markets?
Buckle up. Tony, I've been doing this as some kind of chief investment officer since 1978, and this is about the wildest cocktail I've ever seen in terms of trying to figure out a roadmap. Just to frame things a little, the recession we had last year, or whatever you want to call it, the economic downturn, was 5x the average recession since World War II, but it did it in 25% of the time. More bizarrely, during the year, while 11 million people more were unemployed, we had the largest increase in personal income in 20 years during an economic downturn that's occurred. And of course, as you know, that's because of the massive policy response we got. The CARES Act added trillions of dollars in fiscal stimulus. How big was it? In 3 months, we increased the deficit more than if you took the last 5 recessions combined. And those were big ones. That was 73, 75, the 82 recession, the early 90s, the dot-com bust, and then, of course, the great financial crisis. If you added the increase in the deficit in all those 5 periods and combined them, we increased the deficit in the U.S. more in 3 months in 2020 than we did in that cumulative total. The Fed, in 6 weeks, bought more treasuries than they did in 10 years under Bernanke and Yellen, when people like me were screaming about how excessive QE was during that period. Corporate borrowing, which almost always goes down in a recession as corporations re-liquefy, and had already gone from 6 trillion to 10 trillion because of free money going into the period, actually went up $400 billion. Just to put that in perspective, it went down $500 billion during the great financial crisis. So we had this massive increase in liquidity, this massive increase in stimulus. But this is sort of the background, and obviously all this stimulus has flowed into financial markets, into commodities, into financial interests. So it's sort of a bizarre background. The other thing I would say, I'm excited that we have an Asian audience today, because the juxtaposition of the various policy response is somewhat breathtaking. One of the best ways to encapsulate what I just talked about is, since 2018, M2 in the US has grown 25% more than nominal GDP. So we've had a 25% increase in liquidity. In China, M2 to nominal GDP is where it was 3 years ago. So they haven't borrowed anything from their future. We've had a massive liquidity input, and frankly, very little investment. It's primarily been transfer payments and Fed stimulus, and we've done a horrific job with the virus. The Chinese, basically Asia in general, the Chinese, the Taiwanese, Hong Kong, they pretty much defeated the virus. They haven't borrowed from their future. So the background could not be more different, but it also could not be more exciting if you're a macro investor, because on top of all this, there's the other big force in the equation, which is vaccines. And it's possible, in fact, probable, that all this stimulus is still going to be in place and frankly increasing just when we unleash the biggest increase in pent-up demand globally we've had maybe since the 1920s, which could make the world look extremely different than it looks today.
Okay, so Stanley knows what he's talking about. He hits the nail right on the head. And you can see that there are masters of the universe out there, not just me, that are concerned about this situation. And, you know, the politicians, they go on their merry way. They typically do more damage than they help. It would be better if they just sat there and didn't do anything. But, of course, you have this new administration coming in, and they want to mess things up as much as possible, as quickly as possible. So what does this all mean? I'm not saying get out of the stock market. What I'm saying is we need to watch the bond market and follow the bond market and understand what it's telling us, and keep an eye on this crazy situation in Washington where everyone's trying to one-up themselves on shoveling out money to the American public. I think the economy is going to improve naturally. I think that this last stimulus package is not needed. We should spend the previous one first before we determine if this third one is needed. But obviously, they're going to go ahead and do it anyway because they decided that's what they want to do. So what I would encourage you to do is just be careful. If you have enormous profits in various stocks, I would consider taking some profits. I would look at risk management and realize that this party is not going to last forever. Eventually, the Fed's going to remove the punch bowl. And when that happens, we're all in for a wild ride from market valuations that have never been seen in the history of humanity. All right, well, look, I hope you enjoyed. Hope you got value out of this video. Enjoyed, got value. And I would just ask that if you did get value, please like. It helps me a lot. And also subscribe so you can be on board for future presentations, which will be coming your way real soon.